Hey traders, for today's trade we're looking at one of the most simple option strategies, a long call play, in the Financial Select Sector Spider Fund XLF. So looking at XLF on MarketSmith, the ETF just broke out to a 6-month high ahead of the conclusion of the Federal Reserve's 2-day meeting. Shares are now above support at the 50-day and 21-day lines. While the 200-day moving average is still in a downtrend, the shorter-term moving averages have been trending higher since late last year. On a larger scale, the ETF is starting to show constructive action as it forms the right side of a massive cut base with a 4180 entry. The stock still remains a ways away from that entry though. Investors who think XLF will continue to rally and don't want to risk significant capital can use a long call strategy. This is a cheaper bullish alternative to buying the stock outright while also limiting the downside risk. A call option is a contract between a buyer and a seller. The contract gives the buyer the right to purchase a certain stock at a certain price, known as the strike price, up until the expiration date. Assuming an investor wanted to buy 100 shares of XLF, they would have to invest around $3,650 at the current price. Instead, you could gain a similar exposure using a fraction of the capital by buying a call option. So let's take a look at my trading platform and set up this very simple options trade.
So here we are on my Thinkorswim dashboard, and like I said, we're looking at XLF today. And for this trade, we're going to be looking at the June 16th expiration, and we simply want to go down to find the 36 strike price. So as you can see here, we simply want to buy one June 16th expiring 36 call.
One call option gives you exposure to 100 shares. Buying one XLF 36 call option expiring on June 16th, you would only need to invest around $225 rather than $3,650 for 100 shares. The 36 call option has a delta of 61, which means that it's the same as owning 61 shares of XLF. But that exposure will change over time as the ETF moves. The break-even price for this option trade is equal to the strike price plus the premium paid, or $38.25. The most the trade can lose is the premium paid of $225, which would occur if XLF finishes below 36 on June 16th. However, if the ETF moves higher, the upside is potentially unlimited. Another option with this trade is to further reduce the risk by selling an out-of-the-money call, turning the trade into a bull call spread. So for example, you could sell the June 16th 40 call simultaneously while buying the June 16th 36 call. This call option spread would help to reduce the trade cost by around $40, but it would also cap your gains on the upside if the stock moves above $40 a share. A stop loss could be set if XLF drops 8% from the entry, or if the value of the option trade drops by 40%. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out the new Option Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us for our regular options content where we break down new trade ideas every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.